Thank you very much. Thanks to Barnes & Noble for hosting this, and thanks for you for coming. I know some of you, but I don't know many of you, so I'm hoping to get to know all of you before we're finished this evening. I think first and foremost, this is a book, American Abundance. This is a book about optimism. And are we okay on the, is it going? Okay, good. This is a book about optimism. And it's a book about prosperity and what I call the super cycle long wave of prosperity. It began in the early 1980s, and it was triggered by a new set of economic policies, which did not include the cappuccino maker, but which did include a stronger dollar and lower tax rates and deregulation and free trade, which were launched by President Ronald Reagan, for whom I worked. It's over 15 years ago, actually. And my basic view is that we have launched probably the greatest economic boom since the late 19th century. And when we combine these policy changes, these moves to free market, supply side, entrepreneurial policies, we're probably now, I would say, maybe a quarter of the way or a third of the way through what will be a continued long wave of prosperity well into the next century. And of course, paralleling that, mirroring it, and signaling it is a tremendous bull market we've had in stocks, which also begins in the early 1980s. And the two are very closely related. The change in policies, the new freedom in the economy, the new entrepreneurship, the new technologies, the new innovations, the new wealth creation. And so I'll read the first of several sections that I want to share with you tonight, how I begin the book. On the eve of the 21st century, the United States finds itself in a long wave of prosperity that began 15 years ago and could continue without serious interruption until 2020 or 2030. Stock prices are higher, economic growth is faster, both inflation and unemployment are lower, technological change is more pervasive, the dollar is stronger, social conditions are more hopeful, the public spirit is more confident, and the nation's future is brighter than anyone thought possible 15 or 20 years ago, when pessimism and anxiety were the dominant strains in American life. It was Reagan who restored the country to greatness. And today I am as honored and grateful that I went to work for him as I was 17 years ago. It was Reagan who turned pessimism into optimism through a set of policies that brought back the classical free market model of sound money to eliminate inflation and tax cuts to unleash entrepreneurial forces of growth. And it was Reagan who changed our foreign policy from a passive balance of power defeatism to a forceful articulation of America's democratic values. And the buildup of military hardware to back up those values, thereby ending the Cold War and the imperialism of Soviet communism. And it was Reagan who revitalized the basic U.S. traditions of free markets and free elections, that is to say, of political, economic, and religious freedom. And he turned them into a broad beacon of light, a spirit, really, that with the marvels of advanced high-speed communication technologies was broadcast throughout the world and proceeded to transform the institutions and the behavior of people in every nation and geographical region on the planet. Now, the book begins with the Gipper and talks about his philosophies, but it's really larger than just Mr. Reagan. I am particularly interested in the ideas that lay behind the policies that President Reagan implemented. And so I discuss, as best I can, some of the key thinkers who created the theories that we followed, and which I would argue in the main are still being followed today in this country and in most of the nations around the world. I rank, modestly, the greatest economic thinkers of the 20th century. I call them my 20th century economic greats. And at the top of the list is my favorite dead economist, Joseph Schumpeter, who was an Austrian who, after going through several incarnations, wound up actually teaching, pardon the phrase, at Harvard University in Cambridge, Massachusetts. In those days, the Harvard philosophy was a little different than it is today. Anyway, Schumpeter really invented the notion of the crucial role of the entrepreneur. And it was Schumpeter who basically argued that men and women acting as entrepreneurs would invent or innovate new products and business practices, and would take risks, literally risking personal life and limb, in order to achieve a vision or a goal or a product or a company. And in a free economy, it is these entrepreneurial people, the inventors and the innovators, who create the dynamism and who change and transform on a constant basis and who provide economic growth. These are the people who create the growth, not the governments, not even the pundits or the journalists, but men and women who take risks, the entrepreneurial class. And the role of the government is merely to step out of the way and allow them the profits and proceeds of their risk-taking and their labor. And of course, in our great system, the entrepreneur has the right to succeed marvelously, but he or she also has the right to fail. And failure is part of the evolution of a strong capitalist growth dynamic. So Schumpeter is absolutely vital. And let me add that in the current setting, it's right out of Schumpeter's book, The Theory of Business Cycles, or The Theory of Economic Development. He argued that the greatest wave of prosperity the United States had ever had, and he died in 1950, was the industrial age, the inventions and innovations of the industrial age in the last quarter of the 19th century and the first quarter of the 20th century. And of course, the steamships and the railroadization and the autos and the telephone and the telegraph and so forth and so on. I believe with the advent of the information age, with the miniaturization of knowledge and information through high-speed transmission computing and now spreading to every nook and cranny, this is an exact replication of Schumpeter's historical view of the 19th century. And remember, roughly between the Civil War and World War I was the length of the industrial age. That is about 50 some odd years. So when I say I believe this supercycle wave of prosperity can go on until the year 2000 or the year 2020 or the year 2030, I'm essentially borrowing from the historical past. It's not exactly the same, but we can run 50 or 60 years. And I would add, I think the stock market can go that far as well. Now, there are other heroes in the thinkers, ideas category. I rank Arthur Laffer and Robert Mundell as the next best economists of the 20th century. They were the ones who provided the model for President Reagan. Mundell said you have to have a strong dollar, and Laffer said you have to cut tax rates in order to create incentives to work, produce, invest, and take risks. Both Mundell and Laffer, I confess, are friends of mine. I've known them each for more than 20 years. I actually worked in Art Laffer's office in 1996. My wife and I were living in San Diego in those days. And I'm a student of Laffer's of the sort. I never formally studied under him. But I believe neither he nor Mundell ever get sufficient credit for the intellectual fodder that helped create this changeover of economic policies from the old Keynesian governmental sponsored demand model to this new free market entrepreneurial model. And finally, I rank three very famous economists as the next level, Milton Friedman and Friedrich Hayek and Ludwig von Mises. I actually read as a young man all of the Austrian stuff by Hayek and von Mises. My mind was a lot sharper in those days, and I could get through it. And I had less of an attention deficit disorder in those days. I could sit down for long periods of time and actually learn it. But I think, as I try to argue in the brilliance of Friedman and Hayek and von Mises is really more their dedication to free market principles than any specific economic assertion. And these are the men who fought Keynes and the Keynesians for 30, 40 years, and really until the 1980s hardly got the recognition. Turns out Friedman and Hayek got Nobel Prizes late in their careers. Von Mises never did. But they believed that it was individual men and women who create the economy. They believed that state planning and state controls and socialism or other forms of command and control economies were despotic and tyrannical and totalitarian. And they believed in economic freedom, first and foremost, as the most important ingredient in the creation of a healthy economy. So I talk quite a bit about them as well in the book. Now, turning a little closer to the here and now, I go through in sections different kinds of politics, and I'll just review them briefly with you in our short period of time. I've described Reagan's growth politics, the politics of tax cutting and economic growth and optimism. Let me raise two other political trends which are inextricably linked to the economy, and I believe will be a huge force, maybe the dominant forces in American political life in the next 10 years or more. First, what I call stock market politics. Stock market politics consists of, presently, more than 125 million people, nearly half the population and equal to the entire working population of the U.S., who own stocks. They are invested in shares, either directly through brokerage accounts or mutual funds or long-term retirement plans or 401ks or IRAs or super IRAs or whatever have you. This number, 125 million, has virtually doubled in the last 10 years. And I think it's the greatest example of democratic capitalism. Literally, the workers in this nation, whether they're white collar or blue collar or pink collar or whatever, the workers of this nation now own the means of production by investing in stock market shares. And so it delights me to argue that Karl Marx is both dead and wrong, as it turns out. Now, what's interesting here in the ownership of stock market shares is that people have done rather well, and that has opened the door for a lot of analysts and academicians to go back and look. And it turns out, in the long run, whether your goal is a comfortable retirement nest egg or whether your goal is just to enhance your own wealth creation, stock market investing is the single best way to go. And the work from Ibbotson of Yale and Siegel of Penn and others have shown that year in, year out, on average, the U.S. stock market goes up 7% per annum, adjusted for inflation. It's the single best investment you can make, better than bonds, better than treasury bills or cash, better than foreign currencies. And although we've had two bad decades of investing in the 1930s and in the 1970s, in the 30s because we had insufferable tariffs and tax increases as well as excessively tight money. In the 70s because we had hyperinflation. The other 8 decades performed extremely well, including this one, which is now coming to an end. Now, I believe with all these people owning stock, and stock market holdings is now the single largest source of American wealth. It just passed housing. They are going to keep Washington and political policymakers on a short free market leash, because our wealth is at stake. Your wealth is at stake. And it isn't just a bunch of rich people. When you get to 125 million, it's everybody. In fact, the largest buyers on the margin of stocks are non-professional white and blue-collar workers and women, both of whose income profile is less than $75,000 a year. And my guess is in the next 10 years, we will see that median come down even lower as more and more people participate in the great free market wealth-creating machine. Now let me turn to surplus politics. It's related to stock market politics. In two pieces in the book, I argued, starting about almost a year ago in the spring of '97, that America was on the verge of a long wave of budgetary surpluses. It was a bit of an incongruous point at the time, but now it's becoming more interesting, salient, even accurate. And in fact, I've just given some talks in Washington in the last week or two, trying to wake up some of the policymakers to this. Even this year, through the first 4 months of fiscal 1998, we're on track for about an $80 billion budget surplus. And it is likely that by the year 2002, yearly surpluses will exceed $300 billion. And by the year 2008, which is as far as the government planning exercises go, we could have $800 or $900 billion under current law, which of course will be changed. But surplus politics, which comes from the very same economic growth factors launched by Reagan over 15 years ago. And Mr. Clinton hasn't really done much harm to that story, so I'm okay with that. In fact, Mr. Clinton signed the capital gains tax cut, so I welcome him to the supply side camp, however, belatedly. What to do with the money is going to be the single biggest factor, what to do with the surpluses. And I advocate very strongly two courses of action, which I believe stock market politics, that is, people in the market, will favor. Number one, across the board tax cuts. We haven't had any since 1986. That's over 11 years ago. A lot of people are being moved into higher tax brackets, from the 15 to the 28% bracket, and to the 31% bracket, and then to the 36% bracket. They're being punished for their success and their prosperity. We need to flatten, reduce, and simplify the income tax rate system. So lower tax rates and widen tax brackets. Second, use the surpluses to completely reform the Social Security system. I don't want to save Social Security as it is. I want to change it. I believe people will spend and invest their own money more wisely than government will, even more wisely than the Social Security trustees will. So I advocate a returning back of the payroll tax contributions to each of us. If not all, then we'll phase in some 50% or so. And we then can invest them in private retirement accounts, which is to say in the stock market, because as you know, the Social Security Fund can only invest in treasury bonds, non-marketable treasury bonds. And the rate of return of the Social Security system as it is now constituted will only be 1% in real terms in the next 20 years, according to all the actuarial estimates, whereas the stock market will throw off at least 7% in real terms, and in the last 15 years has thrown off 12% in real terms. It's a great tragedy that some 50 or 60 million Americans in the prime of their earning life missed the greatest bull market in the century because so much of their savings were put in as contributions to a Social Security fund that yields a very low non-market rate of return. So the two biggest areas to invest these surpluses that I foresee, tax relief and simplification and reform, and Social Security reform, private retirement accounts, so contributors can invest in the private markets and get a good rate of return. If you invest $5,000 every year, $5,000 is a little higher than the average Social Security contribution. You invest $5,000 every year in an average performing mutual fund. At the end of 25 years, roughly a decent retirement interval, that money would be worth $840,000 by retirement. A very handsome nest egg. And if you were blessed enough to pick the top quartile performing mutual funds, that $5,000 a year will yield you $1.4 million for retirement. That is the magic of markets, the magic of wealth creation, the magic of compounding. And it's a much different issue, a much different approach than what the government has done. So, growth politics, stock market politics, surplus politics. There's no better time to reform the federal system than during a great period of prosperity like this one. Folks have jobs, folks are in the market, folks are ready for some change. And my great hope is, as much change as we've had in Washington, there's a lot more coming. Let me quickly make two more points, and I want to open it up to your questions. I discuss in here what we call the investment toolkit, some sort of what I think are intuitive, short-form ways of forecasting the economy and developing an investment strategy, so that, in effect, if you're nice enough to buy this book, you'll know as much as I know, and I'll have been planned obsolescence out of the position, and you'll just take the ball and run with it. You won't need me anymore, which is fine. And what I suggest is that market prices are smarter than government bureaucrats or sophisticated econometric computer models. And by the very simple way of looking at gold or commodity indexes or the exchange rate of the dollar or the shape of the Treasury yield curve, you can determine, as well as the Federal Reserve's staff of 500 PhDs, which direction the economy is going in, which direction the inflation rate is going in, and which direction interest rates are going. And that's really all you need, direction. The government misses the magnitude, but frequently they miss the direction. And if they believed in markets and market prices, which contain all available information, you'd do a lot better. And so I talk about that and apply it to a number of examples over the past, 5 or 6 or 7 years, and you can see that forecasting approach. In addition, I urge you to look at the capital gains tax, which is the single most important entrepreneurial and stock market tax. It's not indexed for inflation. So whenever the inflation rate is low and whenever the capital gains tax rate is low, that is a very bullish signal for the economy and the markets. Incidentally, today, due to the excellent money management policies of Alan Greenspan, we have virtually zero inflation. Furthermore, we have a 20% capital gains tax rate. So the combination of virtually zero inflation and a low federal capital gains tax rate gives us the lowest effective capital gains tax rate in the history of that tax, which goes back to the early 1920s. It is, in short, a very bullish signal for the economy and the market. It is the reason why I believe we still have an excellent chance before this year is out to get to 10,000 on the Dow. And it is the reason why, with 125 million investors who also vote, keeping watch over what Uncle Sam does with regard to taxes and inflation and free market politics, I agree with Mr. Ibbotson of Yale that the trend line for the Dow is going to take us to about 53,000 by the year 2020. We are in place and on track. I know that sounds as incredible as 20 years of surplus politics from the federal budget, but if you don't trust me, at least consider the possibilities that these might be right. Last point is, I believe that prosperity has improved the social conditions and even the moral fiber of the nation. This is a point dear to my heart as I've gone through my own personal struggles, and by God's grace I'm healthy and productive and before you today. But what I sense, looking at a lot of the statistics for a myriad of vexatious social problems, is that while economic prosperity will not solve all that ails us as a nation, it helps. And I go back to one of the fathers of the economics profession, Adam Smith. 10 years before he wrote his great free market opus, The Wealth of Nations, he wrote The Theory of Moral Sentiment. And the theory of moral sentiment, as befits a leading member of the Scottish Enlightenment in the 18th century, basically argues that free markets and successful economies can only function when the men and women involved in the economy behave according to a moral code of conduct. Contrary to what many free market critics have argued, Smith and his forebears and his followers, including myself, have never believed that free market economics was an open door for libertine or licentious behavior, that we must all have personal responsibility and accountability, and that is how we operate as men and women, as entrepreneurs, as husbands, wives, and spouses, as church and temple goers, as community participants, as fellowship participants. That this was the essence of Adam Smith's vision. And when I look at the data, particularly over the last half dozen years now, as we are well into this super cycle wave of prosperity, fortunately I see a steady decline of welfare, a steady decline of crime, some of the earliest indications of a decline in family breakup, of a decline in unwanted teen pregnancies, and a number of other data points that I discuss. It may be the seeds of another book for me, because it's a subject that interests me a great deal, but it leaves me very hopeful and optimistic that just as our economic cycle is improving, it may well be that our moral cycle is also improving. And again, drawing from Adam Smith, it has everything to do with jobs and employment. Work is its own virtue, Smith argued several hundred years ago. Work teaches good habits. Work teaches virtues. Work teaches morality. Work teaches discipline. And an economy like ours that has thrown off an incredible 36 million new jobs in the last 15 years is an economy that gives plenty of room for learning and teaching good behavior. I believe, and I quote from the book, Adam Smith had it right. Work is its own virtue, so price stability and economic prosperity create cultural as well as material improvement. An example of conservative cultural change is cited by Nobel Prize-winning historian Robert Fogel from the University of Chicago in an article excerpted from the Wall Street Journal in a forthcoming book called The Fourth Great Awakening. Fogel argues that the U.S. prosperity is hand in hand with an upsurge of religiosity and intensification of religious beliefs and the mobilization of believers to shape political and social institutions. He writes, "The new religious revival is fueled by a revulsion in the corruption of contemporary society. It is a rebellion against the preoccupation with material acquisition and sexual debauchery, against indulgence in alcohol, tobacco, gambling, and drugs, against gluttony, against financial greed, and against all other forms of self-indulgence that titillate the senses and destroy the soul." I find myself in great agreement with Mr. Fogel, and of course with the father of free market capitalism, Adam Smith. And again, in The Theory of Moral Sentiments, I'll close on this, It was Smith who argued that the commercial spirit must be fused with the moral spirit. Freedom does not mean rebellion, defiance, disobedience, and disrespect. It must be rooted in moral virtues. We are not just producers and consumers, but we are fathers and mothers, church and temple goers, members of fellowships, part of our community, civic-minded, and public spirit. During the welfare state period now ending, I write, the federal government and the Department of Health and Human Services crowded out our religion and morality. The secular temples of entitlement and victimization blocked spiritual progress. However, today, during the long wave of prosperity, the government role is diminished and cultural attitudes are improving. We are all learning that while self-sufficiency and self-reliance may sound like good capitalist virtues, if they are carried too far, they become inimical to our own moral and spiritual health. Ultimately, they may undermine the free market economy. From my own personal experience, I have come to believe that life is not only about what we can accomplish, but how we behave as we accomplish. It is not only about what we do, but how we do it. Most of all, we must play by the rules. That means respecting other people, respecting institutions, and respecting the community around us. In the end, it means learning, respecting, and following God's will. For whatever our spiritual higher power may be, we must be responsible to it. Think of it, if you will, as a spiritual tax cut. It makes the economy, and all of us within the economy, more prosperous. More will be revealed on this, but this is why I believe we must keep the faith, for faith is always the spirit. And I thank you very much for coming and sharing. And the floor is open. Please, questions, comments, whatever's on your mind. Yes, sir.
I'd like you to comment, if you would, on the low U.S. savings rate, which presumably rises with the elimination of the federal budget deficit. But still, it seems to me, remains quite low in relation to GDP, in relation to other industrial countries. Is it a concern? Is there some ideal savings rate towards which we should be moving, and how do we get there?
There is no ideal saving rate. And it's an odd concept. And I'm not going to subject you to a money and banking macro lecture, but let me say a couple of things. Number one, we save a lot more than the numbers suggest because we don't count it properly. And number two, the primary flow of saving in this country in the last 2 decades has been to invest in the market. In other words, we save to invest. And unlike Japan, which has a tremendous saving rate but very low investment returns, or Korea, which has an even higher saving rate but now no investment, the U.S. has such high capital returns because of our productivity and our technological advances and our growth that people can own a piece of the rock and do so, and they've created $12 trillion of new household net worth in the past 15 years. 12 trillion. That money is not scored in the saving rate. If it were, we'd have a huge saving rate. So that's an important conceptual issue. Also, as I mentioned earlier, for most Americans, the biggest source of saving is their Social Security payroll tax contribution. And regrettably, not only is that not scored in the saving numbers, it would add about $500 billion a year. But it, of course, has led to a very low investment return, almost a discouragement to saving. Now, beyond that, the third point, here's where we need some improvement. We tax saving 2 and 3 and 4 times. That's why our tax code, I believe, has to be reformed. I'm actually advocating a flat tax or some form of a flat income tax. we tax, first, we tax income as earned income, work salary. Then we tax it again. If we invest in a corporation, we tax their profits. Then we're taxed on it in the form of dividends. Then we're taxed on it in the form of interest. Then we're taxed on it in the form of capital gains. And then we're taxed on it in the form of the inheritance, the death taxes. So actually, we have 4, almost 5 layers of taxation heaped on saving alone. It's the same dollar of income. And I think that's a system that needs to be changed. It needs to be reformed. Now, this country doesn't have forced saving the way Japan does or Korea does. We have voluntary saving, which is good. It's freedom. But those are some of the reasons why we don't save enough. And you're quite right. At the end of the day, if we can put the surpluses into a reformation of Social Security, retirement, and the tax code, we will save more, and we will invest with either greater returns, creating commensurately more prosperity. Yes, Rick.
Larry, I share your optimism, but let's look at the other side of the equation. What are the risks and what are the probabilities of the major risks that you see facing us that could divert this secular?
You know, whenever I get this question, and it's a great question, because I won't say it's a time of euphoria. Pardon? Oh, I'm sorry. The question is, what are the risks that might derail this? I think that was your... You know, it's like a lot of things in life. We shouldn't be so worried about the other guys. We should be worried about our own selves. And by that I mean, our economy and our bull market and our long wave of prosperity will not be derailed by other nations. Only we have the power to undercut that. And yes, that power is concentrated in Washington, but that is not the only place of power. And that's why I'm so interested in this theory, and I admit it's an unproven theory, but the notion of stock market politics, where people have a real stake in the political and policy system. It's not just some ethereal Washington thing. It actually now affects their net wealth and their retirement prospects, and presumably their health care prospects, or the prospects of the education of their kids, and on and on. I think they're going to keep politicians on a short leash. Now, let me give you a mini example of a successful working of this theorem. When Mr. Clinton undertook his initial policies in 1993, he had a large tax increase, which he said was taxing the rich, but actually it was quite a pervasive tax increase. And then he tried to federalize the whole healthcare system, which is about 50% of the economy, and really runs counter to the American tradition of freedom, free choice, and free markets. And we had a battle in Washington. And many people felt that inside the Beltway, he won the tax fight, lost the healthcare fight, but no one thought about what was going to happen in the rest of the country, and boom, lo and behold, in 1994 elections, the U.S. Congress, House and Senate, both went Republican for the first time in 40 years. It was an earthquake, a political earthquake. Well, you know, I believe that was the 125 million investors who also vote, they also pay taxes, saying, wait a minute, we don't want any big shift left. We don't want the government taking over large chunks of the economy. We believe we will spend our own money. We believe we can make our own investment decisions, our own healthcare decisions, our own insurance decisions. We believe we can exercise responsibility and self-government. So they, in effect, if it had been a parliamentary government, he would have been thrown out of office, but that was the signal. 1995, 1996, 1997, Mr. Clinton runs for re-election and governs as a basic moderate Howard Baker, Bob Dole type Republican. He has a good ear for the political music, most of the time. And actually signs a tax cut bill, which helps low, middle, and well-to-do people. So this is an example, I think, of the dynamic of stock market politics. Indeed, in the election in 1996, I felt you had two moderate Republicans running, Bob Dole running against Bob Dole. And they voted for the Dole who was alive and kicking, which was Clinton. And so I think that's at least a modest illustration of how stock market politics might work. Now, we're going to test this again and again. There's no doubt about it. We're going to test this thing. But it isn't Asia's currency collapse that'll doom us. It isn't Saddam Hussein that's going to doom us. The biggest mistakes the American nation has made, at least in the economic sphere, have always been homegrown mistakes. The Smoot-Hawley tariffs, the huge tax hikes under Hoover and Roosevelt, the inflationary policies of the late 60s and 70s under Republicans and Democrats. I mean, I'm surprisingly bipartisan when it comes to evaluating these things. So I've seen the enemy in his self, and I need to work on that. And I think it's true in politics and economics as it is in the spiritual vein. Yes, sir.
With all the money being generated and pumped into the stock market, are there enough financial instruments to absorb all that money without, in a way, creating stock price inflation, so that PE ratios keep on going up and up and up, and then where? And when does it stop? Or does it have to stop?
Yeah, I mean, that's an interesting point. A lot of people were arguing. I saw a lot of this in the mid-90s, not so much in the last 12 or 15 months. That companies were buying back their stock and therefore creating a shortage of equity. And so the flows into the market via mutual funds, variable annuities, 401ks, what have you, were boosting prices on the basis of a shortage of paper. But actually, recent studies show that's not the case, because we forget about the extraordinary proliferation of brand new businesses who then sell initial public offering, IPO stock. And in fact, they move from the small cap area to the mid cap area, and obviously in the case of Microsoft and some of those guys, the huge cap area. So my point is, if you think about the evolution, if the economy is strong and dynamic, and entrepreneurs are creating new products, new companies, the companies go public, then the public will have a full menu of options, of equity offerings to purchase. And it's not a static process, it's an ongoing process so long as the incentive system is intact. So no, I don't really fret about that. Now, we had a little minor earthquake today, the Intel sell-off. But Intel is a company, I won't say no one heard about it, but no one talked about it 10, 12 years ago. And now it's one of the giants in our stock market and probably the best semiconductor chip maker and inventor on the globe. But you see, today's Intel, today's Microsoft may not be there tomorrow. That's the whole history of Schumpeterian dynamic gales of creative destruction, about which I write in the book. It's one of my primary themes. And as I'm sure you know, you could put your thumb down the list of the Fortune 500 or the S&P 500 or the Forbes 400 15 years ago, half of them are gone. Just phenomenal. Now, you hate to see it because there's some pain and suffering in these transformational cycles, but it also attests to the extraordinary strength and resilience of not only the American economy, but the American mind. The mind is such a wonderful, creative, unlimited thing, God-given, as long as we don't shackle it with a bunch of goofy regulations from Washington. Yes?
Well, speaking of Microsoft, do you think that the government is shackling? I mean, that's correct in what they're doing with Bill Gates and wanting it to be more like Baby Bell, or?
I think the government's trying to, but I think it's a bad idea. And I'm not going to
agree with his philosophy that it's, that he could be extinct in a year? I mean, that his product is not...
I wouldn't say a year, but I agree with the principle. Absolutely. I don't want to defend Microsoft or according to that, I don't want to give you the sense either that I'm an expert or I have a stake in it. I don't. But the principle, this is one of those ideas that concerns me. I believe the greatest antitrust regulator is the free and open market. And I remember, you know, when I was a young man, a junior economist, working my way up on Wall Street in the 70s, everyone was after IBM. Lawsuits, government, antitrust, Justice Department, Federal Trade Commission, newspapers, bad press, you name it, they had it. Turns out, you know, IBM lost their advantages in a number of places to upstarts like Microsoft and Dell. While the Justice Department was obsessing over IBM, they forgot to look at the extraordinary emergence of the American high-tech economy, which had the inventions on the shelf in the 70s, but with high inflation and interest rates couldn't get funding. Come the Reagan 80s, the economy returns to normal with some fresh tax cut incentives, and all of a sudden, boom. Software, hardware, information technologies, communications technologies, financial services technologies. IBM was, I won't say they're nothing, I'm not here to insult IBM, but their market position was sorely diminished. And this is what Bill Gates is trying to say, I think. I've actually never met him. I watched his hearings on C-SPAN at some length, just to hear his logic, and again, I don't know the specifics of it, although I do believe software prices are falling like all information tech prices. But I think what Gates is saying is, do not hinder or handcuff our innovative potential. The government, for better or worse, and I had served in the federal government, does not know much about innovation. The federal government is not imbued with the discipline of market rates of return. And in particular, the federal government does not have what I would call a sophisticated marketing strategy knowledge. And therefore, they ought to leave that best to the innovators in the private sector. So I would say hands off. I'm sorry that Microsoft's competitors are cranky. But you know, so it goes. And good competition is a very healthy thing. So I'm not taking sides, but in the battleground of ideas, I say hands off. If Microsoft wants to bundle bathtubs in Windows 98, they have the right to do it. And they lose some money, they have the right to do it. Yes, sir.
Hello. You mentioned the increase in stock ownership, and that's part of this prosperity period. Could you comment, if you agree with the idea that the U.S. markets are the deepest and most liquid, could you comment on why you believe that's true, if in fact you agree with that? What is it that makes this market different and better than other markets in the world?
Why is this market deeper, more breadth, and more resilient than other markets in the world? I think basically American financial services technology is unparalleled. Unparalleled. Our capital markets experts, our corporate finance experts, our bond trading experts are the best in the world. And one reason for that is that the U.S. government, with some strictures, basically leaves them alone to innovate. And another reason for that is financial firms, which have made a lot of money in the last few years, have the right and have shown us how to fail. Now, I want to go back to this point. I'm going to connect a dot. We talked about how the Fortune 500, half the list is gone, maybe more than half. You look at a Wall Street firm's tombstone, you know, tombstone. They underwrite IBM, and there's different brackets of maybe 100 firms in the tombstone. You get one out on microfilm or whatever it is, how you do it, let's say in the middle 1970s, and then get the same one out in the late 1990s, and you are going to see a a 75% turnover. One of my former partners on Wall Street is here, but it's a totally different list. Totally different list. Now in Japan, it's very hard to fail. In Korea, it's very hard to fail. And in Indonesia, it's impossible to fail, particularly if you have bloodlines to the Therefore, you don't get the kind of competitive innovation that our guys have. Now, I'm not going to say that every American bank or trader or investment bank is a genius. I'm just saying that somehow or other, in our wisdom, we have created, you know, mortgage-backed securities, derivative securities. We can, you know, price financial risk for the next 10 years. No other country. Now, you see some of this in the United Kingdom and London. Frankly, you don't see much of it in Europe. It's just coming on stream. And this is also part and parcel of our capitalism, the ability of people who are not rich to become rich. You know, we've figured out ways you can leverage your home equity through the use of debt markets. In a sense, you know, you can capitalize your current income stream into future wealth. If you have an idea, somehow you can go to the bank or the savings and loan and either get a mortgage or a second mortgage on your house. The bank or the savings and loan may lay the risk off on the marketplace through securitization or derivatives. But so that the risk is completely diffused, but you get your hands on the capital to start the new Microsoft or whatever. That's why this country is so mobile and flexible. That's the problem in Asia. Ordinary people in Japan cannot do what they can do here. Same thing in Germany. So that's my answer. We do it because we are free to take risks, which means we're free to fail, but it also means we're free to invent. Question? Sure.
You touched upon individuals donating or putting $5,000 towards their financial security for 25 years and it becoming over time $840,000. Now fundamentally I understand that, but financially I can't afford it. So for someone that's under 30, how do you invest smartly so that there's an investment that's being made if you don't have $5,000, but that you can make something with the little bit that you have to invest?
You know, $500, $100. There's no such thing as too little to invest now. This is one of the great things about our financial system. Literally, through these discount houses, through no-load funds, through the internet, you can take a small amount of money, or what appears to be a small amount of money, and start investing with it, start building. Absolutely. In the old days, in fact, the old days aren't so old. Again, when I first came to Wall Street in the 70s, it was real hard to do that. And in fact, the most successful stockbrokers didn't like to return the calls of people they didn't know or people they didn't think were rich. That's all changed now. We've democratized everything. And the expansion of information technology in the financial services game has made it a whole lot cheaper. And it's going to get cheaper still. So if there's a way for you or me to take 1% of our income and invest it, whatever that 1% comes to, we can start that process of compounding through economic growth. And one of the interesting things here, when you look at the demographics of the new investor class, young people are among the biggest, on the margin, participants, the biggest participants, young people. I don't like this term particularly, but Generation X is made up of investors. They're the ones who, you know, the famous poll, I talked about this poll 5 years ago on my CNBC show, but more Generation Xers, roughly 48%, believe in unidentified flying objects, UFOs, than believe they'll ever get Social Security benefits, only 16%. And this is it's a hackneyed poll, but the point is they're investing. Now, they're not investing huge sums of money, but they're investing. And then as they grow with the economy, the investment gets bigger. But I do think, you know, everybody who works pays Social Security payroll tax, right? You've got to pay it. It's withheld. It's withheld. It's tragic that that bundle of money every year does not get a market rate of return. And we have to be able to design a new system that, okay, guarantees the benefits for those people invested in Social Security and gives them a choice. You want to stay in the system? We're going to